thank you for joining us today. My name is Wesley Boudreaux, one of the financial advisors here at the Retirement Group. Today we're going to talk about emotions and how it affects the transition planning process in retirement, and also how it affects our decisions when it comes to investment selection in the markets as well. Before I get started, just a quick reminder that the Retirement Group, even though we've worked extensively with a lot of different companies for the last 30 years, that does not mean we are hired or does not mean we're endorsed or employed by your specific company. Now, throughout the course of this webinar, there's a couple of things to keep in mind. There will be a chat box, so go ahead and keep an eye on that. We'll put some information in there periodically, different items as far as how to schedule an appointment with myself or one of the other advisors in the Retirement Group, maybe how to follow us on LinkedIn, maybe a survey to ask how this webinar went, or give us suggestions for other topics you'd like to see covered in the future. Also, we're going to try and get to some questions. There's a Q&A box in there as well, so feel free to put down any questions you have that you want to get addressed at the end of this webinar. Now, your information is anonymous, your name will not be shown, so feel free to ask away. We'll try to get to as many as we can by the end of the webinar. If we don't get to all of them, we'll try and follow up with you on some of those as well. Now, a quick reminder for those of you who do not know who the Retirement Group is, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition into retirement. I mentioned earlier we've been doing this for right around 30 years or so, and with a lot of companies we've spent that entire time working with them, so we've got a deep understanding of your benefits plans, whether it be the pension, the 401k, healthcare, retiree medical benefits, life insurance, all those different aspects that you have to review when it comes time for retirement. So our goal is to help you understand those, hold your hand through that process, and make sure you avoid a lot of common mistakes. And at the end of the day, when you walk away, make sure you maximize what your company gives you as far as benefits in that transition process. And we do have offices throughout the country, so rest assured if you need to sit down with somebody face-to-face, we can possibly still accommodate that. But obviously, this day and age, it's very easy to have web meetings, phone calls, emails, whatever your preferred communication method is. Just let us know. And at the end of the day, if there's anything you take us up on, it's our complimentary cash flow analysis. This is essentially a detailed financial plan specific to you and your company plans. This is where we can actually really show you if you're on the right path to meet your retirement goals. Let you know if you can retire when you want to, whether you should actually work longer, maybe retire earlier because it's going to affect your benefits. Go through all those different scenarios and show you how it looks not just now, but in 10, 20, 30 years down the road, so you have a better understanding of what that long-term picture is going to look like. And at the end of the day, our job is to help you figure out financially, are you ready to retire? And then, like we'll talk about today, are you emotionally ready to retire? Because that's a different scenario. We've got a lot of individuals we work with who could have retired a couple years ago, but emotionally they just weren't ready. They identify with their job, or vice versa. People that have been ready to hang it up and really shouldn't because they can't afford to do so, but emotionally they're just done with that job. So again, it's really important to review how your emotions come into play with this transition process. And this is really kind of our classic checklist we've always used for the longest time to kind of let you know what's the best way to really have a smooth transition into retirement. And the first thing, which we'll talk about today, is your emotions and being comfortable with your emotions. So first and foremost, it's being comfortable with the decision to retire. And really that kind of goes into running that cash flow analysis I mentioned and making sure you have all the information, all the pieces to be comfortable with your retirement decision. Once you're comfortable with that, then it'll be it'll be a lot easier as far as that transition process is concerned versus kind of just jumping off a cliff and doing it last minute because there's a company change or there's a hurting issue like we'll talk about in the future of this webinar. But really understanding your emotions, how they play into that is first the decision of retirement, and then fast forward as far as your investment strategies in your 401k or in your IRA if you roll over. We'll go through all that and making sure you understand emotionally what your decisions are, and understanding those will definitely make it a smoother transition. And ultimately, what you want to do is look at, as you transition to retirement, decrease your risk and volatility. A lot of times it's very easy to be very aggressive if you've got 5, 10, 15, 20 years ahead of you as far as making contributions versus taking distributions. But once you start taking distributions, it's a different story where you don't want to have a double whammy where you've got a major market correction and you're taking out a percentage of assets, because that's just that much harder to regrow. So you want to focus on decreasing your risk and the volatility. So one of the simplest things I like to say is, I want to get you off the adult roller coaster and get you onto that kiddie roller coaster that still has the ups and downs, but not as severe, and you can manage those more appropriately. And then obviously, in order to have a healthy retirement, you want to increase your retirement income. Now, we're going to focus on a lot of different ways to do this, but really kind of 3 key ways are that number one I mentioned, helping you walk out the door with the most money you can from your company is one way. by decreasing that risk and volatility in the investment management process to help minimize those fluctuations and grow that account is another way. And then a third way is to actually decrease your taxes and penalties. So make sure you keep as much as you can in your pocket and not give too much to Uncle Sam. And that goes from a different standpoints as far as when you retire, are you able to take distributions? Are you under 59.5 or post 59.5? Avoid that 10% penalty in different ways. And then also fast forward to when you're forced to take money out. Make sure that you and your beneficiaries get it tax efficiently, whether it makes sense to do Roth conversions and things of that nature over time. A lot of these things go into play with the overall development of an investment philosophy. And these are things that the retirement group can help you out with. Obviously, it's also stuff you can do on your own, but we would at least recommend taking us up on a review to kind of show you how all this can play out to make sure you do have that smooth transition into retirement. Now, most companies we work with do still have a pension plan, so there's really kind of a three-legged stool we look at as far as sources of income in retirement. First, we're all going to have your Social Security, so that's going to cover hopefully a large chunk of your expenses, and you want to focus on that covering the essential needs. Then beyond that, you're going to have your 401k, if you and the company have been making contributions to it, and also potentially a pension plan. That pension plan could either just be a single life annuity or a joint annuity, or if you have the flexibility and your company allows, it could be a lump sum where you took that as a lump sum and rolled it over to your 401k or over to an IRA because you want to manage that or work with a firm like the retirement group to manage it to outperform what that annuity could have done, or make sure that your beneficiaries are taken care of more than what an annuity would have done as well. So should you have any questions on reviewing that, that goes back to that cash flow analysis where we can show you those options side by side. And then we also have various webinars that go into detail on your specific company plan possibly. But these are really three sources of income that most of our clients are looking at. And the goal is to figure out how to maintain those and grow those over time, and obviously have a sound retirement picture for yourself, and also potentially for legacy if you're looking to pass money on to beneficiaries or charities as well. So today we're going to talk about really two different theories of finance, and then we'll get into some of the emotions that drive our decisions. First, there's the standard theory of finance, which is what we've all essentially kind of grown up with. We'll talk about that in just a moment. But then over the last decade or two, there's been kind of an additional layer, if you would, and that's the behavioral finance theory. And essentially, that's when we add emotions into it, because we're not all robots. We are human beings, and we definitely make mistakes, and our emotions get involved in pretty much any thinking process, but especially when it comes to managing our assets and stock selection as well. So the first, general rule of finance is the standard theory of finance, and that is that we're all rational. We are robots, I guess, is what it's trying to tell us, and it's assuming that we're all rational human beings, and we're going to make appropriate decisions based upon the information we're giving, and we're going to accurately assess all that information. Now, unfortunately, there's everybody's got different education levels and different emotional levels, so we're not going to, everybody can be given the same exact information. We're not going to assess it the exact same way. We're all going to have differences, opinions. And then it's also going to show you that markets are ultimately extremely efficient. They quickly incorporate all known information, and they represent the true value of all securities. Now, in reality, that's not necessarily the case. The stock market's really kind of like a voting machine. It's going to people are going to buy and sell based upon, changes in the market, but it's not going to be stagnant. It's not going to be the same thing day in and day out. So we have to be careful about that. So once we throw emotions in there, again, that behavioral finance, all of this changes. Like I said before, we're not robots. We're not all rational human beings. We can all be given the same information, but we can analyze it and look at it in different methods. So we might make different decisions. And also, we often act on imperfect information. Let's face it, unfortunately, there's a lot of imperfect information coming out now as well. It used to be that it was a slow process for information to come through the pipeline before investment managers and the public knew about it. Now it's coming in seconds or milliseconds, if you would. And the other aspect is that markets, they may be difficult to beat in the long term, actually, but in the short term, there are still anomalies and excesses to take advantage of. You look at the millions or billions, if you would, that firms have invested in millisecond trading because they're trying to take advantage of some of that information as soon as it becomes available before you or I could actually take advantage of it. So again, the markets are not, they try to be efficient, but there are some issues where they can be taken advantage of, if you would. And today's focus is going to be on our investor behavior, because obviously we can't change the the emotions as far as the market, but we can change our emotions, or at least understand our emotions, to make sure we can have a smooth transition to retirement, have a better understanding of our investment strategy when it comes to managing that throughout the course of retirement as well. So what are the importance of investment behavior? I just kind of mentioned it. Better understanding the best day to retire. So that goes into that emotional aspect I mentioned, figuring out when's the best day to retire. So you maximize your benefits. That's something we can help you out with by running that cash flow analysis. Excuse me. Especially if you've got a pension plan option with a lump sum, we can show you the differences between the 401k, differences between the lump sum and the annuity. And a lot of times that if you retire at different times during the year, it can make a big difference in the amount of money you walk away with. So it's really important to understand that and give us a call on those. It'll help you develop better investment strategies, or at least understand those strategies, help you stay the course because you know what your process is. You're not going to deviate and make knee-jerk reactions and essentially buy high and sell low, which a lot of people unfortunately do. And you'll improve your overall investment experience through that process as well. So let's take a look at some of the different emotions that come into play with the stock market. We're going to focus a little bit more here on the big ones there at the bottom, hurting and loss aversion. But let's look at a couple of other ones. Narrow framing. That's something where we narrowly frame our decisions into kind of compartmentalize them, if you would. So let's take, for instance, and this is something we go through all the time. Somebody asks us to look at their 401k but they don't tell us about other assets outside. So we're narrow framing if we're just looking at the investments in a 401k, but maybe you've got a brokerage account or an IRA somewhere else. You need to look at the big picture, not just narrowly look at one specific aspect, because you could be duplicating, or you could be undiversifying if you do one thing in one but not in the other. So it's good to look at the big picture. And that also correlates into the retirement decision. It's not just looking at your decision, but looking at how does Social Security come into play? How is your spouse affected? What's happening with his or her job? So all those things kind of go into the process of the retirement planning. Anchoring is when you kind of anchor onto an aspect and don't let it go. A great example would be a lot of companies we work with have got company stock. So maybe you anchor down that company stock and are not willing to review that truly and understand if it's appropriate to hold as much as you are, or whether it makes sense to sell it. We go through all those different scenarios too when we review your portfolio. Mental accounting is again kind of mentally focusing on a specific segment of your portfolio, for instance. Diversification or naive diversification really is what we see. And that's I've seen this a lot of times, especially in 401ks where you've got limited selection. I've actually seen people just naively diversify, thinking they have to buy one of everything, and they might have 20 fund choices in the plan. They just have 5% in each one. But in reality, there might be 5 of those that do the exact same thing. So you need to truly understand what you're trying to do and diversify appropriately. The disposition effect, hurting, we'll talk about again. Regret, a lot of times we let regret kind of control us. We also let optimism control us, where we think bad things will happen to others and good things will happen to us. We're optimistic about the market in some cases. And obviously the media. We got to be careful and turn off the media sometimes. They're there, remember, to sell advertising space, not necessarily to give you the right advice. So be very careful about what the media is doing and pushing you in the direction of doing as well. So let's get into that hurting and loss aversion. So hurting is one that we see countless times on the investment side, but also we see it on the aspect of retirement decisions with companies we work with. Let me kind of go through that first, and I'll get to the slide here. But ultimately speaking, what's going to happen is we just went through this last year because interest rates skyrocketed, which caused a lot of lump sums to drop. So we helped a lot of individuals make that decision whether or not to retire because their lump sums were dropping. And it was the right decision to retire for a lot of people, but there were also some that came knocking on the door saying, hey, I'm jumping ship, I'm getting out of here because everybody around me is doing it. But when we took a look at the numbers, we told them, hey, you really can't do this. You need to work another 3, 4, 5 years, or maybe go somewhere else and work. But they still decided to jump ship just because everybody was doing it. So that's kind of a hurting effect. I don't want to be as mean as saying the lemmings that we've been told jump off the cliff and stuff. But at the end of the day, you need to focus on your individual situation, not a one size fits all, not what everybody else is doing. So again, focus on yours. Let me take a look at this, and we'll dig in here. Here's another issue. If we look at look at chasing the markets and hurting towards performance. Right now, the way Morningstar reports mutual fund performance is they have a star rating, which gives you the 1 through 5 star. And a lot of times people just simply chase those 5-star performers, which are not going to be that forever. So of the funds with a 5-star rating, 3 years later, only 14% consistently have stayed at a 5-star level. A lot of those drop down to a 4 or 3, even sometimes a 1-star. There's ebbs and flows. There's also studies that have shown that some of the best mutual funds in the history have had some of the worst performance for individuals because they didn't buy and hold them. They went in and out, in and out, and what they did was they actually got out when it was, when it was low, and got in when it was high, because they essentially saw it doing well. They jumped in, saw it take a step back, they jumped out. So again, that gets into that market timing, or the mistakes of market timing, if you would. Now, loss aversion is just generally speaking, most of us are afraid of losses, or we want to make sure that the losses are appropriate for the amount of risk we're looking to take. So there's a disproportionate gain or loss. If we look at this study, most people want to gain between 2 to 2.5 times as much money as they put at risk. So if you want to put in, $100,000 in the market, you're hoping to turn that into 200 or 250,000 over a long-term period in order to take that chance of getting into the market. So again, most people want to return 20,000 off of 10,000 in this example. But simply put, people don't like to lose money, especially as they transition into retirement. The irony of it is, I can't tell you how many times we've talked with individuals that, again, their 401k has done well because they had to set it, forget it. They were aggressive throughout retirement, but now we're looking at them at retirement here, now, or a year or two down the road, and we look at their portfolio, they're still maybe 80, 20, 90% stock, even 100% stock, which is the complete opposite of this loss aversion. That's somebody who, if you just look at it on the, look at the allocation, that's somebody who would be willing to lose quite a bit. If we went back and had, a similar recession we had in 2007, 2008, you could lose 50% of it if you were 100% stock. So we need to really kind of focus on this. A lot of times we uncover this with individuals that just had their head in the sand, which worked, but now as a transition to retirement, you might want to review that allocation and review the ability to focus on loss aversion and maybe protecting some of those assets, or a portion of those that are being used for your essential spending in the coming years. So again, something to focus on and look at. And if we look at, again, I just mentioned kind of market timing aspect of it. Let me kind of zoom in here a little bit more. This is slightly dated, but it gives you a good idea of what happens with the flows of money in and out of mutual funds correlating to the market. So if we look at the green line, if you would, that's the market going up and down over the last 2 decades or so. And the blue bars are the fund flows, meaning money that's been going into equity funds. And if we look at that from left to right, we'll see when the market's down, money's coming out. When the market gets back up, money starts to go in. When the market comes down, money goes out. When the market goes back up, money goes in as well. So this is all kind of shows you, again, the aspect of the common person is chasing those assets. Now, the last couple of years, it's a little bit skewed because this chart goes over mutual funds. There's been an onslaught of ETFs in the mix, so it's not as accurate. But if you look at, again, the 2000s and 2008, that really kind of shows you where money kind of chases the market, goes in or out based upon the performance of it. So again, it focuses on, how much the common person does try and time the market and do it on the opposite. There's also a great Dow bar study that's been coming out for the last 30 years. It shows the average investor versus just a buy and hold with the S&P 500. And generally speaking, the average investor usually returns about 60% of what the market does because of that timing aspect, getting in and getting out and chasing returns as well. So let's talk about inflation. This is one you really can't hide from. We've talked about it for the last couple of years, especially after the pandemic. We talked about it being around the corner and that we knew we would see inflation in 2022. To the extent we saw it, no, we didn't think we'd see it that severely and that quickly. But ultimately speaking, when planning for retirement, we've talked about this before, inflation has a big effect on fixed income. So many fixed income investors do poorly in a climate of rising prices because bond prices generally decline as interest rates go up. This also has an effect on lump sums we saw as well. So let's look at it this way. If a company comes out and issues a bond and it's going to pay 5%, you might be happy with that 5% based upon where interest rates are at that period of time. But if interest rates start rising and that company comes out and issues a new bond and they have to issue it, let's say it's 7%, you don't want that 5% bond anymore. The person out there is not going to want your 5% bond if you go out and try and sell it. So if you try and sell it, they're going to have to give you a discount on that price to purchase it, because otherwise they can go out and buy a 7% bond right now. That's what drives down the bond prices. Now, as this kind of settles out, hopefully what we'll do is we'll see these yields continue to come up and they'll stabilize and we'll see some better performance in the future. But for right now, that rising interest rate is what clobbered bonds, and then it also hit heavily on the stock market because a lot of the growth companies use or borrow money in order to fuel their growth. And when the cost of borrowing goes up, then that's going to hinder their operations as well. So at the end of the day, like I said before, running that cash flow analysis is the best way to tie all this together and understand how you specifically can control your emotions and how your specific retirement picture looks like. You don't want to, again, look at the herding method and just because everybody else around you is retiring, do it. It might be a good catalyst to actually start the planning process. But again, until you've run a cash flow analysis, see what your specific situation looks like. Are you on the right track? How do your benefits play out? We'll go through all of that. We can run multiple scenarios, whether you want to retire now or in 3 years, 5 years. How do you want to look at the pension? Do you want to take it as a lump sum or an annuity? Look at all those side by side so you can see how they look, not just now, but 10, 20, 30 years down the road, how it affects you and also your beneficiaries as well. So just give us a call and take us up on that. We'll be happy to go through it. So like I said, to wrap this up, we'll go through the questions here in just a moment. But always you can reach us at 1-800-900-5867. You can also reach us at info@theretirementgroup.com. And I'll leave these up here while we go through the questions, but there's a couple QR codes on the screen. One is to schedule an appointment with myself or one of the other advisors in the offices. Just go ahead and hold your phone up there. I'll get you into our calendars. If you need to talk with us sooner, you can call us. And there's also one for LinkedIn pages if you'd like to follow along on our general LinkedIn page, or if you want to get into your company-specific LinkedIn page, we provide updated webinars on interest rates, how they're affecting pension calculations, or maybe company plan changes, or just other general webinar information that we have there for you as well. So let me go ahead and see what kind of questions we had coming here, and then go through that. Okay, my 401k is getting hit, I think, because of inflation. What can I do to insulate my portfolio? Okay, so I mentioned a little bit about the inflation before and how it hammered things in 2022, and we're still seeing some effects of it here. And we'll see when the Fed essentially, hopefully, stops raising interest rates, hopefully in the maybe second quarter or something of that nature. So some of the things to do is what the retirement group did last year prior to this inflation, spike, is focusing on maybe being shorter on the yield curve, focus on treasury inflation protected securities, focus on commodities. On the diversification side within stocks, making sure you're more value focused, focus on companies that have cash on hand, are not borrowing money, so kind of shy away from some of the growth companies. Now, a lot of this has kind of already come through the pipeline in 2022, so you may not want to necessarily do that quite as much, but it's still a focus. We still believe that value companies are going to be more protected going forward, and they have that cash on hand to weather the storms. Those are the companies that pay dividends. Now, unfortunately, your 401k, you may not have as much flexibility to do this, so that's why it's important to give us a call. We can review what's available in your 401k and how to allocate that appropriately. And then also talk to you if you're retired, or maybe if you're over 59 and a half, or maybe if your company gives you partial withdrawals, the ability to actually roll over to an IRA. So you have a lot more choices in that ability to diversify, not just in the stock selection and bond selection, but also if you want to add protection measures and things like that, we can dig into those options for you. But again, on a one-on-one basis, depending upon what your flexibility and options are. Okay, I'm getting very worried. I'm 57 and too young to retire, and the lump sum is dropping. I went through the 1980s with high inflation, high interest rates. If I stay, my lump sum might get cut in half in the next couple of years. Okay, that's more of a statement than a question. I guess the question is probably the concern of hanging around and what the future holds. Hopefully we're not going to be going into like we did for the early 80s and stuff, and getting into those double digit numbers. If it is, we're going to be out of the job because we'll probably tell everybody put their money into double digit CDs and treasury bills. But at the end of the day, I think we're going to hopefully control this better. The concern is, again, if you're looking at possibly the lump sum getting smaller and smaller, it doesn't mean that that's your only choice. Where we reviewed things last year for individuals on the pension, the lump sum seemed to be the obvious choice for 90+% of people because it gave the best payout. However, going forward, it may be that the annuity is going to make more sense. So when you just look at that aspect of running that cash flow analysis and figuring out, do you have enough money set aside to meet your goals? The difference might be, instead of having flexibility of taking that lump sum, maybe you've got Social Security plus an annuity, so that way you've got more of a sound set retirement. It's just really going to be a one-on-one situation to take a look at that. But ultimately speaking, we can review that and show you what those options are. And it comes down to, what are you trying to solve for? What are you trying to achieve? How much do you need to spend? And whether you can do that with a lump sum or whether you do it with an annuity, those are the options to look at, and we'll go through all those with you. And then ultimately how to structure that portfolio to meet those goals for potentially continued inflationary pressure as well, and take advantage of that in one form or another. Do you predict that retirement will better suit me next year, or will interest rates continue to rise? I kind of talked about this. I think interest rates are still going to potentially rise a little bit here until the Fed stops, and then it'll kind of slow down. The Fed will stop raising interest rates. The good news is if we look at the PPA, the Pension Protection Act segment rates, which is what most of these companies use to calculate their lump sums, they leveled off in July, August, and they had a big spike in September and October. They came back down November, December. So if that trend continues, we might be at that level where we're starting to level off, and they may start coming down. If they start coming down, they'll start seeing the lump sums go back up. Now, by no means will they go back to where they were in the pandemic levels, because the interest rates were artificially low. The government drove those down low in order to fuel the economy. So hopefully we don't see that happen again, but we should see these kind of level off and then come back down. And then what that will do is that will help the lump sum calculation on pension plans. It'll also help the investment marketplace, especially on the bonds. We go back to the 1930s. Pretty much anytime we've seen the bond market take a hit in a year, it's really come back quite a bit the following year, with the exception of a couple of years in the 70s or so. But we took one of the biggest hits we've ever seen last year in 2022. So if we get to a leveling off point and the Fed stops raising interest rates, and we have the high yield for those bonds, we'll probably see a lot more money chasing those yields, and we'll see a rebound in the bond market as well going forward. Let's wrap. Well, one more. We'll wrap it up. I'm concerned about making a plan, then having unexpected expenses impact my funds to the point of depletion. How can I plan for something like this? Because this really just kind of goes right back to the investment planning and the cash flow analysis we talked about. At the end of the day, obviously, different things can come up that can really hurt our projections, but we can model those in there. So, for instance, when we go through a cash flow analysis, it can be as simple as, hey, I've got my 401k, I've got my pension, I've got Social Security, I need to spend this much money. How long will it last? We can go through that. But also we can go in there and do specific things where, okay, I've got to pay off $40,000 of debt my first year of retirement. I want to do a kitchen remodel for $50,000. I want to buy an RV for this. I got to pay for a kid's wedding. And we can also go in there and say, okay, let's say, something catastrophic happens in a certain year and I got to pay $100,000 in medical expenses. We can go through all those different scenarios and kind of show you how it plays out and kind of be prepared for that. But another way of doing it is making sure, again, that you have different strategies for your different goals. Maybe you've got more, a safe strategy for your short-term spending needs for the next 5 years or so. And then you're able to take on more risk for the longer-term growth aspect. So really, at the end of the day, we can't predict anything specific that's going to kind of creep up and be a surprise. But if you want to model some of those in there, we can. But ultimately, the goal is to have a diversified portfolio to meet those goals, and actually go through scenario testing, which we do as well, and give you scenario tests to show you how this portfolio would react to different scenarios. Whether rising interest rates, a recession like we had in 2007 to 2009, the stock market drop in 2008, rising oil prices. We can go through all those different scenarios to see how a portfolio actually reacts, and then that's the best way we can go through and do that. But if you have something on mind, something that may come up, let us know. We'll put that into the plan to make sure that we plan for that as well. So we covered a lot. If you have any other questions, like I said, give us a call at 1-800-900-5867. And a quick reminder, like I said, we've worked with a lot of your companies for the last 30 years. However, that does not mean we're endorsed by them nor employed by them, but we do have a deep understanding of your benefits plans. So should you have any questions on there, want to dig into a cash flow analysis, or simply have a question answered on your benefits plans, feel free to reach out to us and give us a call. I want to thank everybody for joining us, and we hope you have a great day.